Okay, so angel investor. Usually one individual that is going to help you start up your company, give you the capital, sometimes also give you some support, mentorship, maybe some networks. But the angel investor is generally the person that gives you the money, the seed funding to get you going in exchange for a percentage of your company or shares, something like that. Venture capital, that is usually the same as above, but normally a group of people. Okay, so then we've got a startup. A startup is a new business with some money and some initiative, and basically a company you want to start. Seed money. Now that's the money you need to get yourself off the ground, start paying for things, maybe the premises, maybe the equipment, things like this to get you rolling and moving forward. Equity. That's how much the value of the business is. You might have some equity within the business, or you might own the whole business. So equity is the value you have either in the business or, as I said, the whole business. Slightly different to valuation. That's if you want to entice people or you want a loan from the bank, then the valuation is what other people believe the wealth of the business is. Maybe they've done calculations, they have a professional come in and they can work out from your numbers and your figures exactly what the company's worth and the future earnings. Okay, due diligence. This is basically our homework. So you know how we don't like staying up at night? But this is your money, so you need to make sure you do like financial background checks on the company, financial background checks on the individual. Maybe go to the government website and find out if they've had other businesses before. Have they been bankrupt before? You know, try and find out as much as you can about the business owners and starting up and anybody else that's involved. Maybe the people are great, but their other backers, they may have a shady or a dodgy background. Okay, traction. So this is when your company is starting to get momentum, is starting to build, and you're making profit, and things are starting to go really well. You're getting traction within the marketplace. Now, burn rate, on the other hand, that's when you have your money, your seed money, and you're going through it really quickly. So depending on how much your burn rate is, depends on how quick, and depends how long before you next need to get more funding to keep the business going until you become sustainable. So burn rate is how much it starts to get going. Are you spending £1,000 a week? Are you spending £20,000 a week? And that's the number that is worked out and organized to work out how much and how long before you become profitable. Okay, market share. Now this is where, for example, if you're Facebook or Twitter or another social media, how much of the market, of that industry, do you command? How much of it do you own? Maybe there's 100 different cafes in your town and you're setting up another one. Your market share will be very, very small until you can outlast or outwork the other cafes. All right, so your market share is how much you can get from what is the perceived market in your area. Market share. Target audience. So like your demographic, are you looking for people aged between 18 to 35? Are they young professionals? Are they with a disposable income? Your target audience is very different if you're selling diamonds or if you're selling lattes and mochachinos. So target audience is very important to find out who they are by doing lots of research before you start investing your own money. Okay, Blue Ocean Strategy. Now there's a great book called Blue Ocean Strategy. It's basically about creating or inventing a new market where there wasn't before. And so you have such an amazing service or product that you are extremely different to everybody else out there. And you could say this for maybe the iPad. You know, the tablets weren't really a big thing, and Apple created this market. And so it was a blue ocean strategy. Like if you look outside of your boat and it's just a clear blue ocean everywhere, there's no competitors. No competitors. Blue ocean strategy. ROI, I suspect most of you know this already. Return on investment. So if you put in £10,000 and you have to wait 5 years and then you get, say, I don't know, £17,000, then you can work out your ROI. And it's different for everybody. I think what I hear, the average on a good ROI is 7%. So you have to do your homework before you invest your money. Break-even point. Now, when we talked about the seed money coming in and the burn rate, and this is up until you get to the break-even point, where you start actually making a profit. So you can pay for your overheads, you can pay for all the bills, you can pay for your loan and everything else. Now you start making a profit. Past all that, this now goes into the positive. This now goes into thinking about expanding or paying off and buying out other investors. The break-even point is a real milestone of excitement. All right, board of directors. We all answer to somebody, and usually if you're a startup company or if you're a small business and you're getting bigger and you want funding, generally there's a board of directors to help guide the CEO and help to manage large decisions. And sometimes the board of directors have a large stake within the company, and that's how they're able to get out a CEO, put in another CEO. So board of directors, very important to have them on your side, being able to use them and their knowledge. Very important to know. Board of directors. Okay, unique value proposition. So this is where it gets a little bit different. This is how you can show what you offer, what the market wants, and the overlap of how you're different to other competitors, which is opposite to Blue Ocean strategy. So how are you different? There's like a Venn diagram of 3 circles that overlap, and your unique proposition is the bit in the middle. What everybody about the market and the demand, how much supply there is, and what you offer that's uniquely different. So you're that little bit in the middle. And, is this enough to make a business? Can you make enough money from this? Unique value proposition. So for me, I'm just really good looking. I can't say any more than that. MVP, minimum viable product. So this is like the stripped down, basic, most simple version that you can get out to the public or to the people that can spend money with you. And you can build on this in the future, but just to start with, you need a core product or service that defines you and shows your unique value proposition. And that's where you start. That's how you get people to look. That's how you get people to hand over money. And then as time goes on, you build out much bigger and you diversify over time. But to begin with, you must focus on your MVP, minimal viable product. Okay, if you have any other words, if I've spelled anything wrong, let me know in the comments. See you next time.